Welcome. Today in Mere Finance, we're going to talk about the Russell 2000, which we consider the thermometer of the US economy. It's the real index that shows the health of the US economy. Because as we can see, last decade, the mega cap trend completely overtook every single investment, and still, even the S&P 500 highly depends on the returns of the mega cap. You can see Amazon and Apple at 13% of the weight of the S&P 500. So that doesn't really show the rest of the economy. So let's start. Let's see what this week brought. So this week, lumber futures down 7% for the week. The Russell 2000 down 1.43%. The S&P 500 equal weighted 0.74% up. And long duration treasuries seen here in TLT, which is the grayish line, 1.28%. Shows again the lumber crumbling, small caps crumbling, while long duration treasuries going up usually signifies that we're going to see some drawdown in the market, in the overall market. But let's see what we are thinking. The Russell 2000 total return in pre-election years since 1979, look at this, is usually positive. But in this year, it was negative, almost negative. It was 1.8. Did something change? We don't know. Usually during pre-election years, the party, the government in control, they want to have a good economy. So voters out there go and try to re-elect them. So looking at the Russell 2000 total return going negative in a pre-election year, could be a sign of weakness in the market. But we don't think this is a significant graph to draw conclusions, right? Every 4 years, April can just move up or down, but something to take in consideration. We have been saying that a credit event is brewing. Everything starts in lumbers. This is a chart from Charlie Villayo. You can see this is the lowest in lumber since June 2020. Totally crumbling, 80% down from all-time highs. And lumber spreads in every single part of the economy, because through lumber, you have construction, you have manufacturing, you have industry output, you have housing, so which employs also a lot of people. So if lumber futures are going down, probably signifies economic contraction. Why do we use lumber? Because our commodities like copper or oil, they are more specialized, they're not traded as often, because lumber, you cannot build a house with oil or copper, but you can do it with lumber. So lumber has a more direct correlation with housing. Also, deposits in all commercial banks just declining, up from higher than 18 trillion to 17.3 trillion, significant drop, which is also helping this bank run. And also Charlie Munger said, I think this is the first time we are going to see some changes in deposits going down, lumber going down, but also commercial real estate and auto lending having significant trouble. So I think the banking crisis, because of the high interest rates that the Fed brought, is going to happen. So Charlie Munger said every bank in the country is way tighter on real estate loans today than they were 6 months ago. We have a lot of trouble office buildings, a lot of trouble shopping centers. There's a lot of agony out there. Indeed. And one of the most important news this week was Citizens Bank Auto Finance. Citizens Bank is a big bank. They exited multiple states as of yesterday. As of yesterday will be as of Thursday, when this video was created on Friday. Long-time banks reps were laid off, so people that sell those loans or they understand how to underwrite those loans were laid off. And this is significant because this is the first nationwide prime lender to pull out. What does it mean nationwide? They cover most of the states across the country, prime lender is that they're a significant bank, so most reputable dealerships do business with them. They look for good credit quality and they have the capacity to service different markets in the prime sector, which makes us think that based on the size of their portfolio and based on the prime strategy they have, TD Bank, Truist Bank, Bank of America, US Bank, PNC, Chase might have similar portfolios, so might be having the same trouble, same issue. So in auto lending, in auto dealerships, we will see also some drops. Capital One, also one of the biggest banks in top 10 in the US by deposits, also start closing their auto lending business. So we can see not only auto lending, but also in commercial real estate, how banks are slowing down. And this could be a reaction because of lumber too, that's signifying a slowdown in the economy. So what to do? Well, stay diversified as always in commodities, in real estate, in stocks, in fixed income, in everything, right? Diversification at the end of the day wins because this is just credit cycles. We think we should overweight long duration treasuries as at least that's what we are doing. Because we think debt ceiling will be raised, and when everything starts crumbling little by little, the safe asset is usually long duration treasuries. When the Fed pivots, which per last week's video we see that when something breaks, then the way to fly into safety is long duration treasuries. So thanks for watching and let us know what you think. Don't forget to subscribe and stay tuned for another episode of Mere Finance.